Hello, everyone. Thanks for taking some time out to be here. I'm going to take 20 minutes and hopefully make the case for what I think is probably a generational opportunity in the silver market. So let's get right to it. The 60-40 portfolio, in my view, is broken. If you look at what happened last year, and before I go too far, the 60-40 portfolio is Wall Street's idea of the ideal way to allocate. So that's 60% stocks and 40% bonds. And last year, that portfolio had the worst return since 1999. So in 23 years, the portfolio was down 17%. 10-year bonds were down 17%. The S&P was down 19%. The NASDAQ was down 33%. And so what I'd like you to hold from this chart is what happens over time. It's not just that you get this one-off. These kinds of big drawdowns in the 60-40 portfolio, looking back over the last century, in fact, they come in clusters. So if you see what happened in the 30s, you see what happened in the 70s, these came in clusters. I'm not saying that they're going to come necessarily in subsequent years or in single years that follow each other. You can have gaps in between. And so with last year as such a big drawdown in that portfolio, I'm certainly open to the likeliness, the probability, in fact, that we're going to see stocks and bonds do well this year. They're coming off a considerable low. But as I say, these come in clusters, and I'm certainly expecting over the next decade we're going to see several more of them. And so investors are starting to look for alternatives. Second thing I want to point out is I think long-term important trend is that I think the dollar has peaked. If you look at the US dollar index, it peaked, its long-time high back in 1985 was at 160. It peaked again in 2002 at 120. Last year's high was 112. And what I'd like to bring your attention to in the two previous peaks, so 1985 and 2002, the run-ups and then the sell-offs were quite symmetrical. So it took a few years from bottom to top, and then it took a few more years again from top to bottom when that index bottomed and then started to move sideways. I think we're going to see the same kind of thing happen this time around. As I say, it certainly looks like it peaked last year at 112 last fall. We're currently around 102, and I think the bottom is going to probably be somewhere around the 90 level, which is another 10% or so. And in terms of time frame, I could certainly see that happening this year or next if we get the kind of reaction we had the last two peaks where you have these symmetrical sell-offs. And that's very bullish for commodities and certainly for silver, as I'll point out a bit more in detail later. Inflation, I think that we're facing what I call the inflation decade. These things, this hasn't happened for 40 years. The last time it happened, it didn't go away that easily. I think one of the big mistakes that investors are making is that they're looking at inflation now, and maybe not so much in this room, but a lot of younger investors haven't experienced inflation and how it comes and it sticks. They're looking at this current inflation wave, so that's all the way over on the right, the number one. And they're looking at when did this happen the last time. So that was in the early 80s. So the Fed stepped in, raised rates, inflation pulled back, and they think, well, okay, that's what's going to happen this time. And then inflation's just going to go sideways at low levels for years or decades. And that, I think, is the mistake. I think that the one, in this case, all the way on the right, is similar to the one all the way on the left, which was the first of multiple waves of inflation. When the Fed stepped in and central banks stepped in, inflation pulled back and employment went up. They pulled back again on hiking rates, and inflation took off again. So I think we're in a stagflationary environment, and that's going to continue to play out over probably at least the next decade. You know, we have central banks that are tightening, and they want us to believe that that's sort of closing the spigots on money, but I think that we've got governments that have stepped in, taken that place. I don't think there's been any slowdown in the money printing. You can just look at these two examples, the U.S. Infrastructure Act, the U.S. Inflation Reduction Act. The Infrastructure Act is $1.2 trillion of new spending. A lot of that's going to go into things like transportation, roads, bridges. You can imagine what that's going to do to commodities. And here's one example that affects silver. Of that spending, $7.5 billion alone is going to go into a 500,000 EV charger network in the US, and that's a big demand for silver. And you look at the Inflation Reduction Act, that's aiming to reduce carbon emissions by about 40% by 2030. $370 billion from this act is going to be spent on things like renewable energy and climate measures, and this is going to have huge implications for solar, as I'll demonstrate a little bit later. So, with all these big trends happening, what are the implications for silver? So this chart shows us, it certainly looks like investors are starting to pay attention to alternative assets. As I say, the dollar's been down since September by 10%, and these are all numbers since September. Gold is up 15%, silver's up 24%, and gold and silver miners are up 34%. So it certainly looks like the generalist investor is starting to pay attention to this sector. Obviously disappointed with what happened in stocks and bonds last year, and perhaps expecting, as I do, for more and more that kind of return is going to be playing out going forward. I talked about the dollar. Well, if you do the research, you'll see that the correlation between the US dollar in the last 20 years or so, the US dollar and silver, is a negative 80%. That's a really high correlation. That means that you can explain 80% of the time the move up or down in the silver price by what's happening at the dollar. And given that, well, at least in my view, that the dollar has peaked and likely to start heading lower and stay lower for years ahead, I think that that's going to be a big tailwind for the silver price. Here's an interesting thing about some research done by Oxford Economics. So they looked back to the last 23 years. They ran a number of simulations, varied the different asset classes within a portfolio to see what contribution silver could have to the average portfolio. And so it was interesting to see that, and we're talking about just silver, nothing to do with silver stocks. If you include silver at about 5% to a portfolio, you do two things. You lower the risk and you increase the returns. That's ideal in terms of what you want for adding a specific asset class to your portfolio. So what I don't have here is what Oxford did afterwards. So they said, okay, given their own models, they looked forward 10 years and they said, what kind of allocation to silver would make sense to, again, decrease risk, improve returns? And the result was actually 6% rather than 5% over the next 10 years. And one of the reasons that they justify that is they feel that silver has not moved the way gold has, and so it has less downside risk. So here's a couple of really interesting points that they brought out. Silver not only adds value, but it diversifies, it lowers your risk. The average current portfolio across the board really has only about 0.2% exposure to silver. And that's indirectly through commodities, either commodities producers or commodities funds, that kind of thing. In order to get to the 6% that Oxford Economics recommends, the average portfolio would need to multiply its silver exposure by 30 times. If you would just get to 2%, which is a third of the recommended exposure, you'd still need to multiply your exposure to silver by 10 times. So I think silver being a very small market, it takes very little buying to move the market significantly. And here's an example of how the impact. The silver market is about a tenth the size of the gold market. Here, multiple metals. Silver is all the way on the left. It's about $17 billion a year. The gold market is about $170 billion a year. And so the attraction for silver in terms of the potential upside from buying that steps in really could make the market move considerably. Something interesting to note too is that a lot of silver, in fact, over 70% of silver comes from mining other metals. Only under 30% of silver is actually from mines that produce silver as their primary metal. So you depend on the mining of copper, gold, lead, and zinc to get most of the mined silver. And a lot of the applications for silver are irreplaceable by other metals. So the silver supply is very inelastic. A lot of these miners, again, the ones that produce copper, gold, lead, and zinc, over 70% of all the mined silver supply, they almost don't care what the price of silver is. If the price of silver were to double tomorrow, they'll happily take that higher price for their silver. But because it's such a small portion of their stream of revenue, they don't even try to react to it. So the higher price does nothing to affect, or next to nothing to affect, the supply, and that's why we say that the silver supply is relatively inelastic. And so with low supplies and falling supplies and increasing demand, that suggests even higher silver prices. If you look at what's been happening on the mining side, this is on the country basis, we've been seeing a falling supply of silver for the last 6 years. The three largest silver suppliers, mining suppliers, are Mexico, Peru, and China. And as I say, we've been seeing falling supplies across the board. There's a number of reasons for that. It's hard to find silver mines. Ore grades are falling. And you have all kinds of geopolitical issues. And so the green line is Mexico, the brown line is Peru. And so we've seen, as I say, falling supply from mines across the board. That, again, very bullish for silver. And you have falling supply from mines in the face of the highest demand in decades. Last year we saw 1.2 billion ounces. That was an increase in demand of 16% over the previous year. And you had, facing that, you had 2% overall increase in supply versus 16% increase in demand. So demand is easily outstripping supply. Industrial demand last year was up 6%, fed dramatically by the green transition, solar and EVs. Physical investment was up 18%. Silver jewelry up 29%. Silverware up 72%. So really, demand across the board has been up. 2020 saw a silver surplus of 70 million ounces. Last year, just 2 years later, we saw a silver deficit of almost 200 million ounces. So that's a swing of almost 270 million ounces in the span of 3 years. And the Silver Institute thinks we're going to see ongoing silver supply deficits for the next multiple years. And I was looking at some charts just recently, one that was produced by BMO back in about 2017. And so they were actually forecasting that in 2020, 2021, 2022, we would see around 20 to 30 million ounces of supply deficit. Well, 2022 was a 200 million ounce. It was 10 times almost what they were forecasting. They didn't think we were going to reach supply deficits of 200 million ounces until 2030. So something's happening. All that demand has been pulled forward, and I'm going to talk a little bit about where that demand's coming from. So I think we're going to soon see silver being treated as one of the new critical resources. It's interesting that silver is the most reflective, it's the most conductive of all metals, it's the benchmark. Everything is compared against silver for those two properties. Solar panels require as much as 140 million ounces. That's 12% of all demand of silver every year. That's the single biggest industrial use of silver out there. Automobiles, you've got the growth of EVs. EVs use twice as much silver as gas-powered vehicles. Demand right now is about 60 million ounces. That's a forecast to grow by 50% just in the next 3 years. Electronics use about 50 million ounces. That's expected to grow by also 50% over the next 8 years. So I really think you're going to start to see manufacturers step in like they've done in other metals, things like lithium and so on. They're going to have to start securing supply. So we're not going to just see things like offtake agreements grow. We're going to see manufacturers step in and either take a position in projects, perhaps even take over silver producers entirely, and that's going to be very bullish for this space. So a closer look at solar specifically. Solar, as I say, consumes 12% of the entire silver supply every year, and yet, according to the International Energy Agency, just 3% right now of global electricity comes from solar. And they forecast that by 2030, we're going to see 8.5 times the amount of energy, of global electricity produced from solar panels. So the math is simple. If you say currently we need a little over 100 million ounces of silver every year for solar, And solar is expected to multiply its output by 8.5 times. That would take almost 100% of the current silver supply being applied to the solar industry alone. So as you can imagine, that's very bullish once again for silver. This chart compares silver, gold, and stocks through the S&P and the Dow in the 1970s. So that blue line at the bottom is the Dow. The Dow was flat in the 1970s, and that was before accounting for inflation. Gold was up 1,400%. Silver was up 3,700% just in that decade. This chart shows what happened in these same markets since 2000. So if you ask the average investor what has been the best place to be invested for the last 23 years or so, almost invariably they're going to tell you stocks. Stocks did okay. They were up 200% measured by the S&P and the Dow. Silver was up 370% over that same time frame. Gold was up 520% over that same time frame. Now, granted, they both had a lot more volatility than the S&P, but if you have the patience and the fortitude to sit through that, you've more than doubled what stocks have done over the last 23 years in something very simple, didn't even have to trade it. It just played itself out and delivered fantastic returns. Silver has also proven itself to outperform gold in bull markets. So if you look back at the last two peaks when silver reached $50, so on a percentage basis in 1980, silver dramatically outperformed gold. In 2011, again on a percentage basis, silver dramatically outperformed gold. Right now, silver has been lagging gold, and that's because gold is the one that leads in precious metals bull markets, but ultimately silver ends up catching up and outperforms gold. So this is one of my favorite charts. This is the SLV ETF. The top line is the price, so that reflects the silver price. The bottom line, the blue line, is the number of outstanding shares in the SLV, and it's a reflection of demand for that ETF. So let's compare the left rectangle with the right rectangle. On the left, in 2020, when silver exploded higher from $12 when it bottomed in March of 2020, when we had that COVID pandemic panic, silver went from $12 to $30 in 5 months. That was a 150% return. Outstanding shares in the SLV exploded along higher with the price of silver. That meant the public was participating. They jumped in. They started buying SLV to get exposure to the silver price that was moving higher. This time around, all the way over on the right, you have a very different experience. You have the silver price since last fall has gone up from about $18 to $24. So that's a pretty decent return, about 33%. And yet, if you look at what's happened with the outstanding shares in SLV, complete apathy. People are not interested. The price has moved up. They've not been buying to the same extent that they did back in 2020. So silver is hated. That's a fantastic opportunity for investors to participate. It means that they haven't, the bulk of investors really have not noticed this move in silver yet. So I think that's, again, an opportunity. Silver is very cheap. If you look at across-the-board metals, base metals, precious metals, specialty metals, silver is the only one that's still considerably below its 1980 high. Right now, silver is 50% below nominally its 1980 high. It's 90% below its inflation-adjusted all-time high. And when silver bottomed at $12 in March of 2020, it was still 3 times above its low of 2000 or 2001. And so for me, at least, to see it bottom at a level of $12 that was 3 times as high, that says to me we're still in this secular bull market for silver. Give you some idea of the kinds of returns you can make in silver miners. Pan American Silver between 2001 and 2008 was up 16 times. Wheaton Precious Metals between 2008 and 2011 was up 17 times. I mean, these are the largest cap silver producing companies or silver mining or silver royalty companies you could be involved in. And they offered these kinds of returns. This is about the lowest risk you can get on the equity side in silver, and it's tremendous returns. My ultimate target in silver is that it was going to reach somewhere in the neighborhood of $300. And I know that sounds sensational, but the way I get to that is through multiple ratios. I'm not going to go into the details, but honestly, if you look at what silver has done in previous bull markets, it's really getting set up to do something along those lines, and I think it's very much achievable. So again, just to sum up, Silver Stock Investor is the newsletter that I publish. I cover everything from physical silver and ETFs all the way through royalties, developers, and junior explorers. And to cover the entire space, you can get a lot more detail. The book I published is The Great Silver Bull. It's available on Amazon. I recently produced an audiobook version. And you can follow me at Silver Stock Investor. I'm on Twitter, I'm on LinkedIn. So that's it. Thanks, everyone.